We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Shaun Usmar, founder and CEO of Triple Flag Precious Metals. Thanks for joining me today, Shaun.
Hey, Tom. Thanks. Good to be here.
Excellent to have you. So, with your background in steel and aluminum, what drew you to gold and made you want to kind of run a gold-focused company?
That's a good question. You're starting really in the early 1990s there, because I started as a metallurgist in steel, and then in the aluminum sector before doing my MBA in the United States. And from there, I thought I was going back to operations, but ended up in corporate M&A with Billiton, worked in the BHP-Billiton merger, then joined Mick Davis at Xstrata, co-heading M&A and in various sort of senior executive roles in different places. So I've always had more of a base metals, like the bulk of my career was in the sort of base metals and bulk space before, taking on the Barrick CFO role. So, it's been an interesting journey because it gives you a pretty broad perspective on different sectors, different markets, different businesses, right?
So, with the advantage of all of those different roles and that all those different perspectives that you've gained, what drew you to the gold sector?
So I think there's a few things. The establishment of this business, for example, is just the recognition that I think firstly that it's a sector that I think, has these really beautiful attributes at times where, the rest of the sector is going in a certain correlated way, that there really is this sort of insurance component, which has been really in existence for centuries or millennia. And it seemed to be a sector as well that was really underserved by more conventional forms of financing. I know when I was Barrick CFO, I went in ready to help restructure that business when it was losing a lot of money. And, that was a great challenge. We managed to do that. But it also became pretty clear that for a host of reasons, conventional financing had sort of left the building. In part, you get these equity windows, which would be quite narrow. It's usually very specialized. And you've seen over until fairly recently, a lot of redemptions and outflows from those specialist funds even, and very little generalist investor interest. So it felt like the opportunity to, on the one hand, create a gold investment in a business model that I think has been very proven with a streaming and royalty model, if well executed, with a very strong backer, was a great opportunity. And at the same time, to provide funding to a sector that seems like it could need it. And having worked in, say, big diversified base metal businesses, and then in, at the time, the world's largest gold producer, there's symbiosis between being able to stream, particularly in polymetallics, gold or silver, where guys are interested, say, in copper. You're not competing for their primary commodity. Is an opportunity to unlock value for them as well as for yourselves. So you end up with this really good investment for people looking for a pure precious metals investment. And at the same time, you can provide some very competitive financing that's long dated and very patient for mining companies, whether they want to fix their balance sheet or they want to build the next mine, or they want to do M&A, or whatever the case may be. So having seen this from different sides, more from the executive chair, it just seemed like a really interesting opportunity.
So you mentioned the role of conventional finance in the gold industry. Have you seen that start to come back in at this point? And do you think that's going to be a sign of the recognition of the gold industry, kind of coming back to life?
I think the short answer is not really at the moment. I'm super bullish on this diversification or electrification, decarbonization phase that we're heading into. As much as I'm a bit of a petrol head and I love my cars and bikes, I've been driving EVs for a decade now. I was one of the early adopters with a Model S in, say, 2012. And I'd say as a consumer experience, when people overcome their biases on EVs, I'd say everything, including road trips, unless it's super remote, it's just a better proposition. It just works well. And I think what will happen is, as more and more consumers get that, you're going to hit a tipping point where it just becomes increasingly, conventional for that to take place, whether it's the climate change thematic or otherwise. But just the consumer experience, I think, will drive it in that direction. And I think the OEMs, in particular, as a collective, they were reluctant early on. You're seeing a lot of them moving now with offerings to compete with the Teslas of the world. Mm-hmm. I think once they do the math on the supply side that's needed to service that, it's going to be astounding. I think the ability of the sector to meet that is going to be a real challenge. And I think that's an opportunity.
Mm-hmm. Yeah, that's something that, I've covered many times on the show, is the ability and the kind of the forward-looking demand curve that is going to be unbelievable once this, green revolution really starts. And then, accordingly, the challenges associated with being able to supply all of those raw materials, right?
Yeah, absolutely. And, the question is, as we sit here watching this, this tragedy play out with Ukraine, I think the potential for sort of deglobalization, the back of the pandemic, people looking to actually secure. We used to live in a just-in-time world until recently. Mm-hmm. So, what are the opportunities for new investment to come in that isn't evident, I think, right now, but to be able to secure those supply chains and the investment needed to deliver that, I think, could be substantial.
Mm-hmm. So, Shaun, what is your opinion right now of how the market is working to price gold? Do you think that the institutional investor has forgotten about gold and the role that it really plays in times of uncertainty like this?
It's a good question. I think we've come through a period with the with the pandemic where you've had a lot of people sitting at home, a lot of stimulus that's been poured in, the advent of meme stocks, crypto, and a lot of money pouring into sort of more risk-on speculative situations. I think now with massive inflation, multi-decade high inflation coming in, that likely being turbocharged now in the geopolitical landscape, mm-hmm. I think you're seeing gold do what it does in these times. And it is definitely acting the way that you would see. If anything, I think it's underperforming what it might at this time. I still don't think you're seeing large wholesale movement at this stage from more generalist investors in you, which I'd hope you would see in, as this sort of continues on, because I think there's definitely more room for that to occur. But I think it's in the early innings right now. And I don't see a situation where we're going to click our heels and inflation is going to normalize in the short term.
So do you see a real catalyst that we're going to need for gold to kind of get that kickstart that it needs to set a new high and continue from there?
It's so hard. The one thing I learned when I took on the Barrick CFO role was I spoke to every expert I could find on the precious side, from these super promotional guys to investors to analysts, to try and understand different perspectives on really what drives it. Because I'd always grown up in the more supply demand fundamental world of base and bulk metals, and you're always wrong, but you've got a view as to what you think the future will hold. Mm-hmm. And my conclusion was always, particularly it's essentially a currency, and if you've got a situation where supply and demand is kind of a factor, but it's at the margin, it's more is the dollar strong? How do you think about this going forward? And right now, firstly, on the back of the geopolitical landscape and the sort of crazy uncertainty we've seen, I think there was a lot of expectation with Fed tightening that you would see that really having a very negative effect on precious metal prices. And it underperformed last year, but it's remained actually reasonably robust. I do think that as this plays out and the inflation theme picks up, I think you will not see a step change, but I do think you'll see the potential for that to move higher quite significantly going forward. And it is an environment that is really hard to forecast right now. I mean, if you think about the last 2 or 3 years, the one thing I think we can say is none of us could have expected we would be sort of talking about the things that have been in the news flow over the last couple of years. I think it's exactly the role that gold and precious metals can play in anybody's portfolio, is really as a part of a portfolio to deal with these sorts of areas of uncertainty. So my hope is you'll see more of that being recognized and appreciated, and particularly if you see a risk-off appetite markets underperforming. Markets like the TSX, people are underweight. They want to make sure that they can not underperform. I think you might see some more generalist funds coming into the sector.
Mm-hmm. Of course, you mentioned the first rate hike that we saw in mid-March there. How do you see the relationship between gold and real rates?
We've been in a period of just, huge excess, incredible amounts of debt that have poured in. And it's politically quite hard for people to put that genie in the bottle and not create a recession, for example. So I think the risk that the central banks and the Fed are going to potentially make a policy mistake has got to be there. It's got to be reasonably high. Mm-hmm. We've been in negative real rates, though, for some time, and that's usually an environment which is constructive for gold. And I suspect we're going to see that for quite some time to come still. I mean, the idea that people are going to be super aggressive and, potentially create a significant recession here, I would discount that as a likely scenario in the immediate term.
Mm-hmm. So how do you see the wage price spiral as a significant risk going forward in this environment?
It's hard to say, right? I mean, you look at the unemployment levels; they're looking, quite good. I think there's still a couple of million jobs off pre-pandemic levels in places like the US, but unemployment is low. Stagflation, I think, in this environment is a concern. And it was interesting, even last week, one of the issues we've started seeing mining inflation coming to the fore. Cash costs increased quite significantly. Mm-hmm. I think it was one of the uranium issues last week. It reported, I think, a 14% increase on their all-in sustaining cost year on year. And I think 20% of that was linked to wages. So we've seen up until recently very localized when we think about either our portfolio partners, investing partners, and even some of those who've reported fourth quarter earnings. I think initially that was quite localized. We started seeing some of it in places like Western Australia, maybe Brazil, but then you've got currency weakness. I think there are signs where you're starting to see more and more of that coming to the fore. So that, the likelihood that you're going to see more of this happening and driving inflation, I think, is probably quite reasonable.
Mm-hmm. So as we think of, the cost of commodities skyrocketing, and kind of to your previous point there, speaking more specifically about the gold mining sector, how does the cost of energy, or specifically, let's say, diesel fuel, affect an operating mine? Does a rising oil price help drive the gold price higher as well?
Look, I think under the general point that energy is such an important part of our overall basket of goods in our lives as a driver of inflation in society is significant. So to the extent that it adds to the inflationary pressures and therefore that gold will perhaps be a beneficiary of that, I think there's a chance that you will see that occurring. The one thing that is a concern, of course, that I think is at the core of your question, is the risk of margin compression by mining companies, not just gold producers. Mm-hmm. And of course, if you've got a very either remote site, when I was in the nickel business, one of the sites I love visiting was up in Raglan, up in the Canadian subarctic. But all at that time, there's some wind power up there now, but basically it's all diesel gensets. It is, I can't remember, it was maybe 35% of the cash costs up there were driven through electrical power generation through Arctic diesel, low sulfur Arctic diesel. So, if you're going from $40-50 a barrel and suddenly you're well over 100, you can think what that does for your input costs. So although we're seeing great, increases in nickel prices, copper prices, gold prices are more robust, I think the potential for miners to see some margin compression. And that's before you also factor in what does it mean for the supply chain disruption we've seen for, increases on sustaining capital costs. The potential for margin compression is quite high. It's one of the things that we've liked about, the business model that we've invested in, because we don't tend to suffer margin compression with the royalty and streaming business model. It's one of the advantages, mm-hmm. But I think it's definitely a challenge for equity stories at the moment.
So do you see the possibility of, for example, if that margin compression becomes too high, let's say the cash cost for producing whatever commodity or metal for some of these miners becomes too high, is there a chance that that producer stops production until the underlying commodity reaches a point that they can become profitable again?
Under the banner that it's really hard to focus on just how these future prices could move over time, I think liquidity in this environment is very important, just as a risk mitigant. Having a lot of debt at a time when rates are increasing and you could see margin compression is always a bit of a concern. History tells us that higher cost operations in these times can really end up, particularly if they're like highly geared financially, really could end up in a very difficult position from a liquidity point of view. And I think we're seeing signs of that in Europe, for example, with energy costs going up dramatically. I don't know, coal going up to over $400 a ton, for example, which is like unreal. And we've seen these trading houses now have to look to find new credit lines and really struggling with that over the last couple of weeks. So I think we've seen in the headlines just in the last couple of weeks, cyanide production in Europe has been curtailed on the back of high energy input costs. I think the same with aluminium production because energy costs are so high. We've seen that in the past, as you recall, in parts of North America and that as well, where there's mothballing of capacity as a consequence. So for us, it's the reason that we do focus, because we're long-term investors. You do like to have more exposure to the lower half of the cost curve, and we do a lot of time not just focusing on returns, because these are wonderful things ex ante, but when you're in that investment, how low can things go before you end up with periods of potential impingement, and also how much risk is there beyond the actual operational leverage to the balance sheet and the amount of leverage that financial leverage that these businesses have. So we spend a lot of time focusing on that because that can be an issue. I think thankfully right now commodity prices are high, but I would watch energy input costs, wage inflation, delays on projects, for example, which could lead to potential significant overruns, which could really stress those situations. I think it's been a concern even prior to this latest geopolitical situation with the pandemic and supply chain disruption, but I think that's more of a problem or more of a focal point for investors going forward.
Mm-hmm. So how are you looking at the inflationary picture at the moment from a commodity perspective? Are the higher prices of nearly all commodities a symptom of the central bank money printing or a precursor for what we're going to see to continue for the prices of everyday goods going forward?
That's a good question. I think, firstly, part of it's a symptom with you've just got excess liquidity in the system, inflation increasing. I also think you've got, in the short term, certainly in, say, North America and elsewhere, pent-up demand with people who've been stuck at home who want to go on holiday. They've been doing home improvements. There's the desire to invest in new things, perhaps, that could drive some of that demand for this going forward. And people, I wouldn't say they're price insensitive, but I think in the short term, you could see quite a lot of shorter term demand and people willing to pay for these new goods and services as we hopefully exit this pandemic. So I do think that surplus liquidity, if you will, in the market is a driver. Now, how that's going to play out as rates go up and people have maybe bought a lot more house and suddenly their mortgage payments have gone up and maybe they bought more car and all that's gone in. The cost of filling up at the gas stations is suddenly going up a lot as well. I think that that's going to have a real impact, and you could see if this protracts, maybe some demand destruction from a mining perspective, which would be a concern. But in the short to medium term, prices obviously are reflecting a pretty robust outlook, and we're not seeing a lot of. You look at the inventory levels; they're down, to some pretty critical levels in many commodities.
Yeah, absolutely. So, Shaun, do you see the sanctions on Russia having major effects on the gold mining sector at this point?
It's interesting. I think Larry Fink last week or so in a letter to shareholders or investors said, this latest situation, you're seeing the end of globalization, perhaps. And I do think there's going to be more investment in security of supply and supply chains. I think it is going to drive more inflation. So I do think that's going to have a supportive tailwind on commodities, precious metals for at least the short to medium term.
So what role does consolidation play within the gold sector? Is it a good sign when we see M&A start to pick up within the sector?
It's such a fragmented sector. I really had hoped that you would see more consolidation in the ordinary course. And I think it's great to see sensible transactions that we've seen in the last while. And I think about Agnico Kirkland as a great example, where there's some synergies. There's, not excessive premium one way or the other, perhaps occurring, and the creation of a more robust business that's occurring. So I'd like to think that it's an environment where you would see more of that occurring. My hope is, you talk to many of the banks out there, everyone's very proud to tell you how busy they are right now on corporate opportunities, whether it's gold or elsewhere. Mm-hmm. So I hope it is an environment where we will see more of that, whether it's in some cases, and not just in the gold space, but more broadly, groups looking for growth. Maybe they've got more cash, and others who clearly have a need for liquidity or funding. Maybe it's a combination with some skills. But I think it is an environment which, and more broadly, I think there is a question for the gold space just to have increased relevance. It was one of your earlier questions from an investor perspective. I think that relevance comes through greater scale. Like having tons of small, illiquid investments is not necessarily the path to achieving that. Mm-hmm. We had a meeting with one of our large investors out of Boston not that long ago, who sort of made the point that they were a specialist, but they had one of their generalist PMs join us. And they made the point that, in an environment where they've perhaps put, significant funds into something like Apple with a nearly $3 trillion market cap, and they decided they wanted to move some of that out at a certain point into something more defensive or, as part of their portfolio to precious metals. And then you look at the largest names like Newmont and that are a fraction of that size. There's that general question about how do we as a sector create more scale, relevance, and liquidity for investors. So I think the consolidation story of that is hopefully part of that.
Yeah, that's an interesting point to think about, the ability of large funds to be able to move in and out of some of these stocks without, crashing the stock price, right?
Yeah. And I think you see that particularly when you have seen, say, geopolitical event or some shock in the market, it's the larger, more liquid names that are the immediate beneficiaries of that. And then maybe if you have a protracted situation, you might start seeing that cascading down into smaller, more value-driven names over time. So I think there's definitely a case for creating more scale and liquidity rather than not.
So how do you see the role of a royalty or streaming company within the industry as being a positive for a producer rather than an overhang on future profits and production? Is there a way to structure these deals that is beneficial for both parties?
I think the first point is there has to be, otherwise it's unsustainable. Mm-hmm. So, I came at this initially when I was Barrick CFO and you're restructuring the business. The first thing is you do what you can control. You reduce G&A, you reset your cost structure, you improve your 5-year outlook, you prioritize capital. These are obvious things. So you take a business that's hemorrhaging cash and you make it make cash again. But then you start looking at the portfolio and usually if you're issuing equity in a situation like that, it's super dilutive. Mm-hmm. Usually you've got too much debt in those sorts of environments. So the idea of taking on more is not a great idea. And so when you're starting to look at divesting assets that are maybe non-core, particularly at a low point of the cycle, and weighing that up against, like we did a $610 million stream on Pablo Viejo as part of that restructuring. We paid down, $4 billion of debt just over, I had 13.1 when we started, we did that within a year. The relative merits of having something where you're not ceding control, you're not taking on a lot of onerous covenants. You have the ability to know that you've got an asset with the margins that even through low points in the cycle, it can sustain itself, and you get a very compelling cost of funding. It makes sense. And that was in a in a situation where, the streamer, in that case, Royal Gold, is really competing for primary, some secondary with silver, but gold. The 70% of our portfolio is, we're streaming precious metals as a byproduct. And those are naturally symbiotic. Like if you think about $1 of gold or silver in a diversified that maybe trades at 4 or 5 times EV/EBITDA, and you've entered into a portfolio like ours, and suddenly, hey, presto, it's worth like 14, 15 times plus. There's just a natural value arbitrage there, and it's not something they covered. They're interested in copper, or they're interested in, nickel or other minerals that is really their core business focus. So if you have the ability, as long as you've got a low cost structure and you've got an asset base that even in very low points of the cycle, you're not going to overburden that. And we spend a lot of time on that because you really want this to be something that unlocks value. It has favorable long-term risk characteristics, particularly on new mine builds. Mm-hmm. Most mines take longer and they cost more. And if you've got a ton of debt, you could be betting the farm if things don't go to script. So the ability to include that as part of the funding cocktail can really have some advantages to it. But again, you have to have groups that know how to diligence it, structure it well, and make sure that ultimately you don't overburden the asset, because that's bad for the mining company. And by extension, it's then bad for whoever holds that instrument. So we do a lot of that. And then in addition, we invest money. Just ESG is crucial to any mining venture, increasingly so. For us, it means good due diligence upfront, because those partnerships you live with for decades. So if you're in partnership with someone who just doesn't share your values, it's not a good strategy. But then it's beyond that, is can you enhance the work that they do with their communities and with their employee base to enhance their privilege to operate. And so I've come out of businesses like Xstrata, 5 times Jones Sustainability Index leaders. Like this is part of like the DNA of the sector, I think, and being good custodians of these resources for society. So you have to make sure that you can help and you can be a force of good as a capital provider. And for us, like in RB Platter, we've got an online virtual mine tour to give you a sense of it. These guys have built schools. They help educate people. They've helped in the pandemic with hospitals and helping their societies. We put $100,000 US a year alongside them to help give back to the sector through educating engineers and geologists, but also to help them with their doorstep communities and things like that. I think we've all got a role to play on that. And then things like climate change, regardless of where you're on the spectrum of this, whether it's political or otherwise, it is a natural area that the sector has to come to terms with. And there, we transparently report it, and we invest in offsets so that that we're carbon neutral. And then we work with our partners to try and make sure that we can share good practices and help them improve their carbon footprint.
Mm-hmm. Yeah, it's an interesting point. And I've heard you speak before about, kind of bringing that younger talent and a new set of eyes into the sector. So how important do you see that as being, and how underserved do you think let's say the mining and gold industry is by a younger generation at this point?
I think it's a chronic problem the sector has faced, and I think it's becoming acute. So if I think back to, I did my MBA at Kellogg in 97 through 99. In my class of 660 students, I was the only guy in mining, period. So, and I suspect is not a unique example. So that was before the whole super cycle thing that kicked off in the early 2000s. We did see an influx of some new talent over that period. But then, of course, we probably had a decade nearly of, I'd say discipline, buy downs, very limited new builds, and the demographics have we haven't drawn a lot of good new talent. We don't do it on a sustained basis into the sector. We don't invest in this. And it's a time now, but I think the average age of people in the sector in Canada, last time I looked, was in the mid-40s. So, there's a real need for replenishment. And my hope is, as we get into this next phase, and it's not maybe this year or next year, but as we get into this next phase with decarbonization, the whole theme around climate change, the metals intensity associated with that can create for people looking for purpose in their careers, a younger generation, the ability to be able to bring those groups in, to be able to actually reposition ourselves as not these sort of mining Neanderthals, but like ability to apply new technology, new thinking, and groups who can really make not just a difference to more broadly to society as part of that more sustainable future, but also on the front lines. I mean, we really do some incredible work as a sector when done well with frontline communities, like just at the most basic level. And I think we can do a better job of being able to help people appreciate that and then draw on good new talent. So it's been a thematic that's been there for a long time, and I think it's really acute if we're going to meet some of those new supply numbers that I think the world needs.
Yeah, as we're kind of having this conversation, it makes me think of what potential changes we could see within the sector if we concentrated on it with the intensity that some of these tech companies have, the attention that they have gained, right?
Yeah, we haven't had as a sector, a great history with, let's say, sustained investment and innovation, just as a general point. I know that there have been breakthroughs and some reasonable investment, but usually at the low point in the cycle, people cut back on a lot of those things. And whether it's exploration spend, certainly technology and innovation, you do need it on a sustained basis. And I've had the view for a while that I think if we end up in a far more intensive investment phase out of necessity for this climate change thematic, I think that will draw in not just new talent, but I think you'll see capability from outside our sector that will actually help drive that and disrupt it. It's not visible right now, but I suspect you may see that. The equivalent of, like an Elon Musk doing SpaceX, which everyone thought he was nuts. And I mean, who would have thought in such a consolidated sector with such high barriers to entry, when a lot of billionaires had come and thrown money at it and failed, that you would see a private sector participant essentially like step change the cost curve of getting things into low Earth orbit and into space. That seemed incredibly improbable. I think there's a scenario, I'm not sure how likely it is, but I could see that happening in our sector as the catalyst for disruption out of necessity in the future, as opposed to, the current collective talent base suddenly transforming the way we think and our approach to doing it. Perhaps it's a combination.
Yeah, that's an excellent point, Shaun. So I've spoken with some investors within the space before that said that they believe at some point that companies would renegotiate or stop paying royalties altogether when the gold price really takes off. So do you see this as a risk within the royalty model?
Short answer is no. I think it depends, of course, on the fundamentals here. I mean, I won't mention him, but one of my directors on my board, before he joined, he had been on the other end of a mining company with, a streaming and royalty operator that had over-encumbered the asset. And that had really created conflict between the mining company and that particular business in question. He wasn't interested in joining us if that was, we operated in that way. And we obviously convinced him that that's not how we go about it. And this happens to be true because having always been on that side of the table, we probably spend more time on understanding the capacity of the asset versus the notional returns, because the notional returns aren't achievable if you don't have a robust underlying situation. So I think that really does matter, is like, what's the context? How do you make sure that you are not in conflict? And so I'll go back to an example like, we've been going nearly 6 years now. The largest precious metal streaming deal that's been done in that time was North Parkes in Australia, which we did in 2020 for $550 million. So it's a copper mine that's been going for 28 years and has sort of decades of life ahead of it. But we stream gold and silver. It's a lower sort of quartile, second quartile type asset. It's got ample headroom and a lot of opportunity and tons of resources, like more than 500 million tons. So those are the sorts of opportunities that offer you, for the operator, it's not a core asset that they care about. They're a copper producer. You unlock that arbitrage we talked about, and it's like a very small part of the overall revenue proposition. So it doesn't create, call it impingement with the underlying stakeholder. So that's how we've approached it and how we think about it. But I don't see that as a risk, certainly from our point of view.
Right. Yeah, that's an interesting way to kind of structure these deals so that, it is not, let's say, their core focus asset that's being encumbered in some way?
So symbiosis is an easier thing, right? I mean, if you're not competing directly, we've got some of our assets in the portfolio where you are helping fund areas where you are sharing in the primary product. But I really do like the idea where there's byproducts, and I think for the decarbonization theme, there's a lot of that opportunity in the years ahead.
Mm-hmm. So, Shaun, how do you try to create optionality and scalability within the deals that you structure?
It's a really good question. I think when we started this business, it was a thing that we thought about fundamentally, because it's all easy as a blank sheet of paper before you've done anything, to think about the sector. And then the question is, can you deliver on how you think about it? And I feel we've done that. So we looked at it and we bifurcated it and said, look, the smaller end, that's usually existing royalties people are accumulating. They're not necessarily funding new mine builds or whatever the case may be. Usually smaller checks, low barriers to entry. But on the larger end, there's only a few guys who can do those larger checks and have the technical, commercial, structuring capabilities to do those deals. And so that's where we chose to compete. That we said notionally was sort of the $1 to $500 million sort of check size. And we found a lot of opportunity to be able to participate in those areas. So I think there's been a consistent pipeline of those sorts of deals. We're probably as active now as I think we've ever been. And as I look to the next 5 years plus, I see more and more of those in the headlines. So I see a lot of possibility to continue to, particularly with polymetallics, unlock value for the sector.
So speaking specifically, let's say with your role as CFO of Barrick, obviously that gives you a very interesting perspective, having worked at a major producer like that. So how does that kind of inform or guide your role now as you're building Triple Flag?
It's a great question. So look, I'd first encountered this business model actually when I was co-heading M&A in London with Xstrata. So we, in our first year having listed in London, we did a deal with MIM. We bought that business, and as part of that portfolio, we had Alumbrera. I think it was a 50% stake in that copper asset with some precious metals. And at the time, I think it was Ian Telfer flew over to London to try and convince us to stream the gold out of that deposit. And you could see the arbitrage for the first time, I think, on display. We did the deal, as I mentioned, as part of the restructuring, and as Kevin Thompson ran that for us, but a team that had restructured this, and when you're sitting in the executive chair and you're looking to weigh off all these alternatives, selling off assets at an unfortunate time in the cycle and losing that optionality, issuing dilutive equity, doing convertibles, whatever the case may be, everything's on the table at that stage. Mm-hmm. So I think that experience, one, it forces you to put yourself, because you've been in that seat, to think acutely about the choices, because you're not just competing with the guy next to you in the same sector, you're competing with more conventional forms of funding. And I think that experience allows you to be able to think about how you put ideas in front of mining companies that you think will solve the problems you think they have. And that's how we usually approach things. We participate in all the competitive stuff that is out there, but we spend a lot of time putting ourselves in the seats and in the minds of management and proactively putting ideas in front of them. So what that's meant for us, we've got 79 assets in the portfolio. I think it's 18 deals now after looking at 550 plus over the last nearly 6 years. So we've been very selective. And I think of our 18 deals, 13 of those have been bilateral, which means we've worked with mining companies with ideas to help solve their problems, or fund their strategic priorities, or unlock value from a non-core asset that they have that they don't really see a lot of value as a strategic part of their portfolio. Mm-hmm. So I think that background has informed how we think about it, even formed our entry, because when you're looking at large checks and structuring, when we looked at the very significant deal 610 million on Pablo Viejo, you realize very quickly there's only a few guys who compete in that space. So the competitive vectors are contained, which is the reason partly why we chose to compete in that space, because we realized there's a know-how component that we built and we had. And there's also just the ability to be able to understand that not everybody sees the same set of facts the same way. There's a potential to apply judgment there. And I just realized I didn't fully answer your earlier question around optionality. And how do you maintain that? Because on our deals, I think the way that we've approached it is to maintain the discipline on the things that make this business model work well. So that means not capping streams, because patience should reward your investors and you participate with mine life extension and the like. Part of that means that you participate in that future tail in a way that doesn't overburden the investment and can still encourage the miner to invest in exploration, mine life extension, and the like. So that is a commercial skill set and a technical skill set. The other one is just the participation in the exploration land packages around that, because if you don't have exposure to that, you lose that optionality. And so you'll see it in our portfolio. Our reserves are on less than 1% of the overall land package that our investors are exposed to. And half of the overall land package is contiguous to existing mines. And less than half of exploration discoveries ever become mines, for example. So if you're on land on existing mines with good prospectivity, those are your low risk, high potential opportunities that provide you with the optionality that you were referring to. So that's how we've done it, and I think we've enjoyed good success with that.
Yeah, it sounds like a really interesting and different way to look at, let's say, creating some of these streams and royalties that it's an interesting perspective that you're bringing to the space, Shaun.
That's right. I think the only other observation is when we think about the space as a whole, I do think, having spent the bulk of my career and a lot of my team members as well in more the base metal side, so this thematic around there is symbiosis with polymetallics. You're not competing head to head with a gold miner for a gold ounce. You unlock the cost of capital benefits, all the things we spoke about. When you spent a lot of the time in, say, the nickel business and elsewhere, and you understand that these vertically integrated chains, from digging it out the ground to smelting to refining, you have a very good understanding of that, the working capital pipelines, the cost structures, what it actually means to those operators. We're not entirely unique, but I think we're quite distinctive in the competitive landscape. A lot of guys have spent most of their careers just in precious metals, or maybe in the investment banking or finance side. So we're primarily miners when we come at this, and we try and think as miners as we put ideas in front of mining companies. It has to be a win-win to work.
Absolutely. Well, Shaun, I think that's a pretty good place to kind of wrap up our conversation for today. Is there anything else you'd like to touch on or mention?
No, I think your questions have been quite varied and really interesting. Hopefully we answered them all, but I really enjoyed chatting to you. So thank you.
Absolutely. It's been great. Of course, you're available, Shaun Usmar, on LinkedIn, and of course, tripleflagpm.com for anybody that wants to learn more. Thanks so much for your time today, Shaun.
Thanks, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.